In this video, we're going to talk about cash secured puts and how you can trade the cash secured put strategy. In my last video, I talked about how you could sell puts, for example, on Wells Fargo, and I explained my thought process when selling a put, but I received a comment asking for the difference between cash secured puts and puts in general. So I wanted to make this video so as to clarify what are cash secured puts, what you can do with them, and how you can trade them. So hopefully, if you're wondering what is the difference between normal puts and cash secured puts, you can have a clear understanding of what are cash secured puts so you can use them for yourself in your own account. So the way this video is going to go is that at first I'm going to describe more in theory what are cash secured puts, and then because with examples it's always better, I'm going to go for an example of a cash secured put on a certain stocks, and we're going to see the different outcomes together of this cash secured puts so you can have a clear understanding of what are cash secured puts. But before diving into this video, I'm not going to ask you to subscribe right now. If by the end of the video you have found this video helpful and you actually learned something, then please don't hesitate to subscribe to my channel and liking this video. That's really the best way to support me, and I'd really appreciate it. But first of all, let's talk about what are cash secured puts. So cash secured puts essentially are no different than selling regular puts, like for example like I did in my previous video on Wells Fargo. Essentially you're just selling a put. But we call that cash secured because you're setting aside enough cash so as to cover a potential assignment. Because remember, when you're selling a put, if your put expires in the money or the buyer of the put decides to exercise his option, then you have to purchase 100 shares of the stock at the strike price. That's the obligation that you have when you sell options. If the option buyer decides to exercise his option, or the put expires, or the option expires in the money, then you have to cover the assignment. You have to. But right now you're probably wondering, what is the matter with cash secured puts? Why is it important? Why are we putting an emphasis on the fact that it's cash secured and the fact that we're setting aside enough cash so as to cover the assignment? Why does it matter? Well, it matters because when you're selling cash secured puts, you're not really afraid of the assignment per se, because you're mentally ready to take on the assignment if your put expires in the money, for example. And that's quite important because right now you are not necessarily considering the P&L when the trade is open and you're going to see the fluctuations in your P&L. You're going to be a lot more focused on either you're going to be assigned or if your put is going to expire worthless. And personally, when I really started trading options, cash secured puts were one of my go-to strategies because I felt that it was very simple as a strategy. Either you're going to be assigned or your put is going to expire worthless. And I feel that especially for beginners, it's a really nice strategy because it really helps understanding the fundamentals about options trading. So to sum it up, a cash secured put is when you sell a put and you have enough cash so as to cover the assignments. But obviously, I know that with examples, it's always better and it's always clearer. So let's go into TestyWorks so I can show you some examples of cash secured puts. So right now we are in the TestyWorks platform, and the first question when you arrive in your trading platform obviously is, which stock should you choose for the cash secured put strategy? Well, there's not necessarily a rule per se when you choose a stock using, for example, this strategy. However, there are some guidelines that can help you know which stock you should choose for the cash secured put strategy. Because we know that you are ready when you sell a cash secured put, you are ready to take on the assignment if your put expires in the money. In that case, because you are potentially considering owning 100 shares of the stock at some point, then it wouldn't make sense to go for a stock that you wouldn't mind owning. So at least if you are getting assigned, then in that case you are going to have 100 shares of a stock that you believe in the fundamentals, and you don't mind owning it. And I think that that point of selling a cash secured put on a stock that you don't mind owning, I think it's really important because it's going to help you be a lot more peaceful about the put that you're selling, and you're not going to stress if your put goes in the money because you don't mind owning the stock anyway. So obviously I don't know which stock you want to own, so for the sake of the example, I'm going to, let's say, go for the stock Alcoa, and I'm going to consider that this is a stock that I wouldn't mind owning. Then once you have chosen your stock, and obviously here I chose Alcoa, but I want to say that I don't necessarily want to own Alcoa. This is more for the sake of the example, but you got my point. If there's a stock that you don't mind owning, then it's probably better to go for this one. The next question is, once you have chosen the stock, which expiration should you choose? Because you see that I selected Alcoa. You can see at the top that is written Alcoa, but you can see that there are plenty of different expirations. So which one should you choose? Well, exactly like the stock, unfortunately, there's not necessarily a rule per se on which expiration should you choose. However, here's what you need to know about different expirations. The longer dated the expiration, the more premium there is in the option. And that's what we call the time value. The more time there is between now and the expiration date, the more value there is going to be in the option. So if, for example, let's say that you sell an option that is, let's say, 100 days versus selling an option that is going to expire in 10 days, the expiration that is going to expire in 100 days is going to have a lot more premium into it, which means more profit for you as an option seller. However, do you want to sell an option that is going to expire in 100 days? That's up to you. After that, there are differences between longer dated expirations and shorter dated expirations in terms of Greeks. So if you've been into options, I'm pretty sure that you're familiar with what we call the Greeks. Those are risk measures of volatility, the time decay, the stock, and how it's all going to impact the option price. And what you can see in general is that the closer you are to expiration, the more the option price is going to depend on the stock's movements. And the longer dated the expiration, the more it's going to depend on the volatility. But when you're selling a cash secured put, and this is really one of the best advantages of this strategy, is that you're not going to necessarily focus on the P&L fluctuations until the expiration. You're going to be focused on two possible outcomes. Either your option expires in the money or your option expires at the money. So I'm not going to say that the choice of the expiration doesn't matter, because it's not true, but it's not as important as when you're focusing on, for example, trying to take your profit at like 50% or whatever. Because you're selling a cash secured put and you're literally ready to take on the assignment and you're more considering those two different outcomes, either your put expires at the money or in the money, then the choice of the expiration becomes less important in terms of Greeks, because you're not going to focus on the P&L fluctuations and trying to buy back your option after that. But personally, I usually like to go between 30 days, 40 days to expiration. This is usually my sweet spot for me, because the time decay, and for those who want to know what the time decay is, every day that passes, option lose a tiny bit of value, and that's what we call the time decay. And usually you must be used to that graph where you can see that the closer you are to expiration, the bigger the time decay, meaning that the more value the options are going to lose as they get to expiration. However, when you sell at the money options, then the time decay tends to go faster when it's around 40 days to expiration, 30 days to expiration. So if you're willing to, for example, capitalize on the time decay, so the option is losing value faster than the others, if we look at this graph, you can see that at the money option, so that's going to be the blue line, is losing more value around the 60 days to expiration mark compared to, for example, at the money option that tend to lose more value after the 30 days to expiration mark. So you can see that if you're focusing, for example, on the time decay, then selling options around the 50 days to expiration, 40 days to expiration is going to be a better sweet spot for you, because the time decay is going faster for the at the money options during that time. After that, because we're focusing on either the option is expiring at the money or in the money, then, you know, it's not as important as when you focus on trying to buy back your option. But for the sake of the example, let's say that I'm choosing the 40 day to expiration October 15th. Then once you've chosen the expiration, obviously comes the next question: which strike should you choose? Well, for the strike, that is more going to depend on which price are you actually comfortable to owning the shares at. For example, right now Alcoa is around $47 per share, and if we look at the graph, we can see that Alcoa has been going up over time, and for example, it went from $31 per share to now $47 per share. And that's really where the cash secured put could make sense, because the rationale behind it is like, instead of buying, for example, the shares at $47 per share and paying a super high price for it, then you might as well sell a cash secured put at a lower strike. So if, for example, the stock continues going up, at least, you know, you're getting paid for being patient, because you're selling those cash secured puts and you're basically being paid while waiting for the stock to come back down. So for example, in the case of Alcoa, if I was willing to sell an option, why not, for example, the 41 strike? The delta of that option would be 21, meaning that I would have around 79% probability of seeing my option expire at the money. And I would receive a credit of $1.14, which means a profit of $114. Because think about it, when you buy an option as an option buyer, you're paying a debit directly when you press the buy button. So as an option seller, when you're selling the option, you receive the credit instantly in your account, and that credit is in your account, by the moment you sold the option, and it's not going to go away until you decide to buy back your option. And regardless if there is an assignment or your option expires out the money, you're still keeping the credit. Even if you are being assigned, you still keep the credit. I thought that this was quite important to mention, so it's completely clear. But in the case of our strike price at $41 per share, it means that if you're selling that put and you're willing to own 100 shares of Alcoa at $41 per share, it means that you will need to provide $4,100 worth of assignments in case if your put expires in the money. So if we look at the chart, it means that if Alcoa goes below $41 per share, below that purple line, I am then going to be assigned, my put is going to expire in the money, and in that case I'll need to buy 100 shares at $41 per share. And to be clear, when you said that we set aside enough cash so as to cover the assignment, you don't have to do anything in your account. It's more about being mindful about how much cash you have in your account and if you're able to cover this assignment. Because I know that usually it sounds like you need to do something when you sell a cash secured put versus selling a regular put, but it's essentially the same thing. It's more being mindful about how much free cash you have in your account and are you able to cover the assignment, and then you are ready to take on a cash secured put because you know that you have enough cash in your account. After that, nothing prevents you from, for example, selling a put that is further out the money. It's going to increase your probability of profit. You can see that now my POP, which means probability of profit, is around 88% compared to before where it was around 79%. But obviously the drawback of having a high probability of profit is that you're going to earn less money. And it's always this balance that in options we're playing with. Either you're right almost 100% of the time, but you're almost not making money, or you decrease your probability of profit and you're making more money. For example, if I decide to sell a put that is closer to the at the money strike, for example, around the 45 strike, I would collect $2.43, but now I will have a probability of profit of 66%. So you can see that you need to make the choice between, are you willing to earn more money but have essentially less probability of profit, and so having more probabilities of seeing your put expires in the money, or do you want to have more chances of seeing your put expires at the money but collect less credit, which means earning less money? And once again, I want to really emphasize that there is no right or wrong answer here. It's more about what are you comfortable, what is the strike price at which you're comfortable owning the shares at, and essentially you need to see it that way, or at least that's how I see it when I sell cash secured puts. You're getting paid for being patient. For example, if we look at the chart of Alcoa right now, even if the stock continues to go up and you sell puts that are continuously expiring out the money, then it's fine because you're being paid to be patient until the stock starts coming back down, and then you're getting assigned at a way better strike price compared to if you had bought the shares outright directly at $47 per share in our example of Alcoa. So you really need to see it as a nice way of getting paid while being patient compared to someone who wouldn't do anything, who would just wait for the stock to go down so he can buy the shares at a lower price per share. You are getting paid for actually waiting for the price to go down. So it's quite nice to sell cash secured puts when you don't mind owning the stock. And that's why we come back to really, I think in my opinion, the most important factor is choosing a stock that you wouldn't mind owning. And that's why for me this strategy all makes sense, is that if you're willing to own shares of a stock, then you might as well sell puts on it so you can be paid while being patient for the stock to come down, so you have in the end a better price per share and you have been earning money for that time where you have been waiting. So it's it's a win-win situation for everyone. And of course the risk of that strategy is that if the stock continues to go down and you have been assigned, you're going to lose money because your shares are going to lose value. However, it would be no different than someone who would have owned the shares directly and who would see their shares losing value. But as I said, if you're willing to own the stock and then the stock goes down, at least it's a stock that you wouldn't mind owning. It's a better outcome than a stock that you wouldn't want to own anyway. So I know that I'm talking a lot right now, but I feel it's important to understand, more the fundamentals and philosophy behind it, because I think that this is really a nice strategy, especially when you're starting options. After that, once you have decided your strike strike, and let's say that you chose, in the case of Alcoa, the 41 strike, you collect a credit of $1.14. And then you can confirm the order and sell it, and then boom, then you will have sold the option, you will have collected a credit of $1.14, and now you have two outcomes in front of you. Either the stock stays above that purple line, which is the $41 per share level, and in that case, nothing happens, and you can keep selling another cash secured put again, or the stock goes down below that threshold, and in that case, you're getting a sign and you need to provide 41 times 100, because there are 100 shares in one option contract, and you need to provide $4,100 worth of assignments. And that's really what I love about the cash secured put strategy, is that it's very simple. You have two outcomes possible. You don't mind about the P&L fluctuations until the expiration. You're really focused on either the put is expiring in the money or out the money. After that, nothing prevents you, instead of, for example, going into the October expiration, to go for a closer dated expiration, as we only care about those two different outcomes. For example, the September 17th expiration that is expiring in 12 days, and sell puts that have a shorter dated expiration, so you can do it more often. For example, in the September 17th expiration, we can see that if you decide to sell the 45 put option, you're going to collect a credit of 87 cents. But obviously you notice here that there is less premium compared to the longer dated expiration, compared to the October expiration. And of course, you cannot have like the best of both worlds. If you want to go for a shorter dated expiration, then you're going to collect less credit overall, because your strikes are going to be closer to the out the money strikes. You can see that the 41 strikes where in the October expiration was going to make me collect $1.14 of credit. In the September expiration, I'm only collecting 19 cents of credit. So obviously you're making way less money if you decide to go for the out the money strike, in that case the 41 strike. And that's obviously the drawback of going for a shorter dated expiration, because you're going to have less credit for the out the money strikes, and you're going to have to go for the closer at the money strikes so as to collect more credit. For example, you will need to go for the 45, 46 strikes so as to collect a decent credit. But obviously the chances of seeing your put expiring in the money are bigger if you go to the closer at the money strike. So you can see that there is not a direct answer to which expiration should you choose and which strike should you choose. You're always playing with that balance of either probability of profit and the credit that you receive. And in the end, it's up to you to decide what you're comfortable with. Do you want to go for the shorter dated expiration so you can sell cash secured puts more often, but you're going to have to go for the closer at the money strike so as to collect a decent credit? Or do you want to go for longer dated expirations where you can go further out the money, but you won't be able to sell cash secured puts as often as someone who would sell them in a shorter dated expiration? I hope this video was interesting and I managed to show you how powerful this strategy is, especially when you go for a stock that you don't mind owning. If you have any question or if you have any comment, I'd be happy to answer any question that you might have. And if you have enjoyed this video and you actually learned something about, for example, cash secured puts and the differences between the expirations, the strikes, then don't hesitate to subscribe to my channel and liking this video. As I said, it's really the best way to support me and it helps me know which videos you really like and which videos you don't like. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.